For the first half of 2025, we saw a lot of buyers sitting on the sidelines as they waited for lower interest rates that seemed to be just around the corner, as well as just better overall economic conditions that would allow them the confidence to be able to jump into the housing market. So in this video, we're going to jump into the September 2025 housing market update for Halton Region here in the West GTA. So let's get into it. So the first statistic that we're going to look at here is going to be new listings. So obviously that's just the number of new listings that are coming onto the market every month. Now that's kind of really been a bit of a headwind a little bit in the last, at least 2025 for sure. So jumping into the September numbers, I'm going to take a glance at it on my computer here. We did see in September as Halton Region as a whole, new inventory, new listings, coming up on the market was increased by 19% year over year. So between September 2024 and September 2025, new listings coming onto the market was increased by 19% across the entire region. Majority of those came from Burlington, which was a 29% increase, and Halton Hills, which is a 28% increase, followed by Milton at 14 and Oakville at 13. So the next numbers we'll look at are sales. The sales in the region were up 9% year over year from 2024 to September 2025 here. So certainly good to see those sales numbers coming up. Once again, Burlington led the way as far as sales go. So while they were up 29% in new listings, they were also up 16% in sales year over year. Certainly a good thing as well. So again, nice to see the increase in the number of sales year over year. Next up will be active listings. So the active listings are going to be kind of a combination of the number of new listings on the market minus the number of sales, and of course people that take their houses off the market with whatever's left over from the month before. So unfortunately, while the sales were up, which was a good sign, it wasn't up enough to offset the large increase in the number of new listings. As a whole, Halton Region saw a 24% increase in active listings year over year, with Milton leading the way on that one with 31% increase in active listings year over year. Now, one thing I will note is that there's the segment of the overall real estate market. It was the townhouses that had the biggest jump in Milton with a 50% increase year over year in just that kind of like that segment of the market. You kind of dig into that and say, well, why would it just be the townhouses? Now, if you know the Milton market, then you know that there's a ton of development, deemed places to grow by the Ontario government, et cetera. And, a lot of builders built that segment of the market, probably oversupplied a little bit. We did have, much larger immigration numbers in the past, and the townhouse market was a great segment of the market for new immigrants. It got their foot in the door, got them here, et cetera. So with immigration maybe being pulled back a little bit, furthermore, immigration into good, strong paying jobs, manufacturing and logistics, all that kind of stuff. The part of our economy that is being hit the hardest right now just means that the buyers for that segment of the market aren't here. And so you're seeing, I think what we're seeing there is we're seeing the townhouse market maybe just get a little bit oversupplied right now. Now, days on market is another one that we like to kind of follow, and that's just to kind of give us an understanding of how quickly things do move. Now, I will put a little caveat to that and say that if there's a house on the market and they remove it, they cancel the listing, they take it off the market, it's no longer active for sale, then that is counted in days on market. How long is a property on the market for before it's removed? Not necessarily before it's sold. So when we're looking at these stats, they won't necessarily account for houses that have been relisted multiple times, et cetera, right? So just take this with a grain of salt. But again, it's just one of these things that we kind of look at to see how quickly things are moving or how quickly things are maybe pivoting if the seller decides to take it off the market or relist for a different price. So what we saw here was we saw Halton Region as a whole move from 30 days to 36 days. on average, of course. Ideally, in a not stumbling housing market, we'll call it, and houses are actually selling quite well and quite more times than not, then that's a good metric to kind of get an understanding of how quickly things are moving. Unfortunately, the last couple of years where houses are coming off the market, which again is not a bad thing at all, because there's an underlying health there to the housing market. If sellers put their house on the market and they're not getting what they want and they take it off the market, that's just as much a good thing as it might be perceived as a bad thing, because it means that, fine, I'm okay to hold it. I don't have to sell it. I'm not in a place of desperation where I have to just unload it at all costs, right? So even though you see a house coming off the market, you might think, oh wow, the market's bad. And while the buyers, like I said, aren't here en masse right now, there's not an overwhelming amount of confidence in the buyer side of the market, it does mean that sellers are still confident. Sellers are still confident in their ability to hold their house for longer if they have to and or want to. So interest rates, of course, is a big factor as well to the health of the housing market. Obviously, when we saw this already play out very recently, when interest rates dropped to basically below zero, essentially, because interest rates were lower than inflation was through the COVID pandemic. Everybody had money. Everybody could afford things, and thus the market went crazy because of, when you have a still relatively limited supply, but the demand goes through the roof, then there was way more demand than there was supply. Well, then the opposite happens when all of a sudden, interest rates kind of spike to the point where now not nobody, but much fewer people can afford to jump into the housing market, can afford to stretch the dollar, etc. Well, now demand has diminished significantly, and supply is relatively stable and or starts to creep up as well. So really, that's what we kind of started to see. Now, as I'm sure you already know, the Bank of Canada lowered interest rates in September by 25 basis points. That was the first time since the spring, since March. Now that turned into a large shrinking of GDP. Went down 1.6%, 44,000 job losses in August, and which equates to, I think it was 86,000 job losses for the year so far. Might have been more. Maybe that was just since March. I can't remember the exact data there. But the fact of the matter is the economy is not doing well under its current conditions, and thus we needed to lower interest rates in order to be able to try to stimulate a little bit of borrowing, a little bit of growth. So, like I said, interest rates dropped a little bit, which I think probably gave us a little bit of a boost as far as the buyer confidence, if not limited. When we saw the year-over-year growth in number of sales. So there are buyers out there. They've got a lot of options. They've got a lot of choices. And I think that the interest rates dropping certainly helped. And I believe we're going to see another interest rate drop in the next week or two. I think it's on the 17th, if I remember correctly. I am going off of memory here, but mid-October roughly is when the next rate announcement will be. And again, wouldn't be surprised if we saw another rate drop coming then as well. So the last bit of data that we'll look at here will be prices. So of course, much of what we just talked about, new listings, sales, and interest rates certainly will, and active listings will certainly feed into what the prices are doing. We saw a 5.8% decline year over year, September to September in Halton Region as a whole. So the average price in Halton Region right now is $1,185,878. The largest increase that we did see was in Halton Hills with a 24% increase. Now, keep in mind, Halton Hills is still a relatively small market. So sometimes only a couple of sales can really influence the overall average price. Okay, so it's great to have all this data, but what does it mean to you? It really depends on where you are in your real estate journey, right? If you're just a seller, or sorry, you're not a seller, you're just a homeowner just sitting there and you're going to be there for another 10 years, it doesn't make a lick of difference really, right? Because I think what we're going through right now will be relatively short-lived. I think I'll touch on this in a second. We'll have a little bit more of a chop ahead of us. But if you don't have anything to do, any moving to do, doesn't make any difference to you whatsoever. But if you are a first-time home buyer or you're an upsizer, I would say that over the next year would probably be a good time to start to get into the market. And I know you've heard this a bazillion times before, buy now, or before it's too late. And I certainly don't want to echo that in the slightest. In fact, what I'm going to get to in a second will be the correlation between back testing this to see what happened in the past. So if you're a buyer or an upsizer that's looking to get into something a little bit bigger, I think that now being over the next year will be a good time for you, because I think the bottom is probably going to be about a year away or so, and I'll touch on that again in a second. But I think that you have a lot of options right now, and if you are planning on buying for the longer term, right? It's not going to be a 1, 2, 3 year kind of venture, but you're looking for a 5, 6, 7, 8, 10 year venture. Then getting in over the next year when the time is right for you, et cetera, makes a lot of sense, because you do have a lot of inventory, a lot of options, and you have the negotiating power right now. If you are a downsizer, or someone that's looking to cash out entirely, I think that you need to kind of maybe weigh your options right now, because I think that the market is going to go a little bit, I think it's going to go down a little bit more from here. And then how long does it take to hit the bottom, and how long does it take to kind of recover? So if you are, looking to cash out, et cetera, what's your timeline like? Can you hang on for another, I'll just say, and I'm not promising that's not a crystal ball, but, can you hang on for another 5 years to wait this out? Or do you knock on the door of retirement and you don't want to retire, in 5 years from now, you want to retire next year or the year after. Sorry, I hit the camera there. So I think, you got some thinking to do. Investors, I would stay out. I think there's a lot. I don't think that the real estate market is offering anything of value right now. Flips don't really seem to be there. Nobody wants to pay a premium for anything good, and I think the market is going to be melting down from here. So I think there's a lot of risk on the table, unless you find that fire sale. But then I don't know, what's your conscience like when you're taking advantage of someone that is in desperation, right? But anyways, that's another topic, I suppose, and totally up to you. As far as where we're going from here, I think that there's a lot of similarities between what we're seeing now and the 90s. I back tested all of this. I looked at all the similar situations, et cetera, between what we saw in the 90s and what we're seeing now, and other housing corrections. So I looked at the 80s, I looked at the 70s, I looked at the 2008 financial crisis, COVID, of course, whatever. The 70s, oil embargo, not quite the same. The 80s, massive inflation, not the same amount of debt. So, again, not quite the same. The 90s seemed to be the most similar. 2008, again, the U.S. financial crisis, we were fine, but we just there was a lot of panic sells, and it was short-lived. Again, an outside influence that didn't really affect us so much. COVID, again, same idea. Everything shutting down. We're not seeing that right now either. So I think that the 90s was probably the most similar. So we had, a roughly similar amount of inflation, roughly similar amount of unemployment that we're seeing right now. In the 90s, we had, in 1991, we had a 10.3% unemployment rate, and 92, 93, an 11.2% unemployment rate. We had higher debt levels, et cetera. So the 90s saw, inflation kind of taking off a little bit. They raised interest rates to combat that. Then we had a lot of unemployment. There was still a lot of debt that was carried, et cetera. So a lot of similarities to today, not identical, I know that, but similarities. And if we look at that cycle, that was a 6-year cycle. It took 6 years between 89 and 96 before the market kind of started to pull back out of that, right? And so if we look at that being a 6-year cycle, and we say that we're 3.5 years into our current correction cycle. And that the economic outlook isn't, gleaming with positivity right now. We're still having job losses. We're still in a trade war. We don't have economic growth. We don't have economic investment into the country right now. Inflation is for the most part under control, I believe. Interest rates are continuing to come down, or they should continue to come down, et cetera. I think that we're probably going to continue to melt down from here, probably for another year before we then start to pull back out of that. And if I look at the 90s and say, okay, well, your real decline from a peak to trough back then was a 39% drop. And just so you know, when you look at raw numbers, the real decline is taking into consideration inflation, right? So when you have inflation numbers of 5, 6, 7, 8%, you have to take that into consideration of your buying power of your dollar, right? And that's really what inflation is. It's the erosion of your buying power, the value of your dollar. So if you see just housing prices, just kind of like your ticket price, you have to consider what the value is in comparison to the dollar. And that's what your real decline is. So they saw 39%. So far, peak to trough, we're at 29%, right? In this 3 years. Again, we peaked at about a little over 8, I think it was 8.1 maybe percent inflation a couple of years ago, right? So we have to take that into consideration. So, if we look at what happened then, what's happening now, there's a lot of similarities, and I could very well see, we need to see sales increase. We need to see new listings decrease, and we need to see that active inventory start to come down so that there's not as much options before house prices start to stabilize. And I don't see that happening necessarily in the short term, meaning like in the next couple of months, right? So if that's not next couple of months, is the next 6 months, we get through, we get through this budget that the government's supposed to be tabling soon. We get through that. We get hopefully eventually get a trade deal. And then we start to get new investment coming back into the country, hopefully, or at least the certainty or the lack of uncertainty that a lot of companies and et cetera, as investors into the country, they don't have the confidence to be moving in right now. So once we kind of like maybe get through all that, that would give consumers as a whole the confidence to be able to start buying up inventory and getting back into the housing market. And then we may start to see prices stabilize. So when does that happen, and how far down do we go? So if I go back and say, if you are someone that's downsizing or cashing out of the market, if you don't do it now, then you do it a year from now, and how low are interest rate, or how low are prices? How much lower are prices now next year? Are they another 6% lower? And then how long until they come back up 6% till you're back to today's prices, if that makes sense, right? So all that to say, there's a lot going on here, and I'm just trying to give you guys as much as I possibly can as to pull back the curtain a little bit to explain what we're seeing and where we might likely go. Again, I don't have a crystal ball. Nobody does. I'm just looking at the data, back testing it, and seeing what kind of correlations we might be able to see to kind of give an indication of where we might end up going from here. So if you found this useful, make sure that you like and subscribe. And this was your September 2025 market update for Halton Region. We'll see you on the next video.